Japan's new prime minister is proposing a radical economic stimulus. Now, that has been hard on Japanese bonds because, of course, it'll tend to increase the government's debt load. But so far, Japanese stocks have been holding up. And that's our spotlight for the ETF report today. One way in Toronto to play the Japanese market is the BMO Japan Index ETF. There's the stock over the past year, ZJPN, and you can see it's had quite a rally after that bottoming. All markets pretty well bottomed in April amid fears over US President Donald Trump's tariff threats. Let's have a look at the big holdings in this particular fund, and you can see it's familiar names: Toyota, Mitsubishi Financial, giant banking entity, Sony, Hitachi, and SoftBank. So you got quite the spread there between high tech and a more traditional industrial company. It uses this ETF does use financial instruments to try to hedge Japanese currency exposure. Well, let's stick with that theme of Japan announcing a new $1 trillion stimulus package. It could have wider implications for the global economy. Our guest says that rising bond yields in Japan will tighten global liquidity, increase overseas borrowing costs, and could pose challenges for equities, debt, and cryptocurrencies. We're joined by Thomas Urano, Co-Chief Investment Officer and Managing Partner at Sage Advisory. Thanks very much indeed for joining us.
Yeah, thank you. I appreciate the time.
So we've had Japanese interest rates going up, long bond yields hitting their highest in decades. And so just give us the background. We've had for it seems like a generation. We've had this so-called carry trade. Investors would borrow cheap in Japan and invest elsewhere. So that may be eroding now. Can you tell us why that matters?
Yeah, so we've had for decades a scenario where funding costs, i.e. interest rates in Japan, have been demonstrably lower than the rest of the world, right? We've made it attractive for international investors to borrow yen or fund in yen and turn around and move those dollars or those yen into other markets around the globe, either in higher yielding or higher returning assets, whether that be fixed income or risk assets. So it's been a scenario where Japan has been able to export capital to the rest of the world, and that capital, of course, found its home in various asset markets. However, as we've seen over the last several years, the yield in Japan, interest rates in Japan have been rising substantially. 10-year JGBs have risen 7x since the fourth quarter of 22. They've gone from 25 basis points to now 1.8%. And the problem with that is, as you include your FX hedge costs into that, suddenly the interest rate differentials make it less attractive or unprofitable even to move assets out of yen or fund in yen and invest overseas.
So this could dry up liquidity or a source of funding that investors and speculators have used for decades?
Sure. So as those funds have moved out of Japan into the rest of the world, if the dynamics of those economics shift, meaning rising JGB yields increase the borrowing cost or make it more attractive for institutional investors in Japan to bring that money home, i.e. repatriate those dollars back into yen, that's going to be some headwinds, right? That's going to be a draw on capital from foreign markets back into Japan's market.
So there's a double whammy here. Then money could be drawn back to Japan to buy domestic money to buy their local bonds, but also there could be a source of funding cut off for the global market.
Sure, right, and that's exactly the risk here that's occurring, right? If this happens in size, and those differentials in funding versus yields abroad, if they become significant enough to motivate investors to move money back towards yen, what does that look like? That could be headwinds for yields abroad, right? As some of those investors have been borrowing in yen and investing in sovereign domestic markets, U.S. yields, European yields, emerging market debt. If that money leaves, it could be a headwind for yields in those markets. It would add FX volatility as you start to think about unwinding hedges and move from foreign markets back to yen. And then I think that would just, in general, be a headwind as a liquidity drain on markets globally.
That's interesting, isn't it? I wonder, could that be? I mean, who knows? It was the failure of an obscure Austrian bank that helped to spark the global depression in the 30s. I wonder, could this be a catalyst?
Sure, I'm not saying that we're going to have a depression,
No,
right?
no.
But I would say one of the tailwinds that's been occurring for decades, because of the interest rate differentials in Japan versus the rest of the world, has been Japan has been a large exporter of liquidity, right? And maybe that tailwind is drying up. There's been a significant, I'll say, rewriting of yield differentials between Japan and the rest of the world. And if that's the case, then fund flows back towards Japan, or at least a lack of additional flows from Japan into foreign markets, again, could be a headwind for liquidity going forward.
And Japan, it seems like forever, since at least 1989, when I think the previous peak for their market was, it's just had this moribund growth. This new leader in Japan determined to juice that?
Sure. I think if you look at Japanese equities, what are they responding to? Well, on the one hand, $135 billion stimulus package designed to support GDP growth, which has been lagging in Japan, right? So what are they talking about doing? This is the largest package since the pandemic. They're talking about providing energy subsidies, tax cuts, some handouts, basically anything they can to support direct consumption in Japan and GDP growth in Japan. So a positive aspect, to be sure, but also consider the concept too that if there's this repatriation effort, what does that look like? That means some dollars moving back to Japan that can also be supportive for capital markets in Japan.
It is fascinating that I do remember, I think this was prior to the housing crisis, though. People in markets like Hungary were borrowing money at low Japanese interest rates and buying real estate. So this has been going on for a long time, this cheap Japanese funding.
Sure. Yeah. Like I said, Japan has been a funding currency for decades. The fact that that differential is changing, I think it's just something investors need to pay attention to, right? If it's a scenario where, funding in local markets in Japan is going to dry up liquidity and depress investment demand for opportunities in foreign markets, it's certainly a headwind for capital appreciation in those assets.
And what about Japan itself? Can you generalize? Is the equity market there looking like good value?
I can only say that I think in terms of Japan on the equity side, you have to respond to what the growth picture looks like there. Right? They've been struggling, right? There's a reason the new prime minister is coming on board. There's a reason she's proposing a very substantial stimulus package. Their GDP growth has been weak. It's been sub 1%. For third quarter of this year, it was actually in contraction, down about 40 basis points. So, thinking about equity growth or equities in Japan, I think you have to think about what's the outlook for obviously domestic growth in Japan, but then also, there's some hope involved here that the stimulus package will help drive growth back into positive territory. Targets or estimates are somewhere near 1.25%, maybe 1.5% for 2025. And perhaps the stimulus package could push it a little higher than that.
Thank you very much indeed. I really appreciate it, Thomas.
Thank you.
Thomas Urano, Co-Chief Investment Officer and Managing Partner at Sage Advisory.